Guys, there are 3 stocks that are sitting near their 52-week lows, and the market seems to think they might be trash, but the numbers tell a different story. Are these hidden gems? We're going to break it down right now and find out. And guys, just like everything in the world, we don't know what the right place to buy, the right time to buy. What we're trying to do on this channel is come up with a process and how we look at businesses for the long run, 10, 20, 30 years down the road. So if these stocks make sense to you after we do our analysis, go do some more analysis and figure out if you're a buyer or if you're going to hold. And guys, you don't hear this anywhere else. All the other channels are telling you what you need to buy right now to become rich. We do not say that. We're trying to teach a process. Now, guys, I love looking at 52-week low stocks. Just because a stock is at a 52-week low does not mean it's cheap. It just means it's less expensive than it was at some point in the last year. It's a great place to start looking for value, because for it to hit that low, it needs to be based on the market saying we've turned against this for whatever reason. So as you go along on your investing journey, you decide to buy individual stocks, I think this is a great place to look. And in our community here, software, we have 52-week low and near 52-week low lists. So it just gives it to you right then and there. Stock number 1, Chipotle. This is a company that I absolutely love because I eat at Chipotle like I'm addicted to it. When the E. coli thing happened, I went on Facebook and wrote, I would rather have E. coli than not have Chipotle. And I was praying that I got E. coli so my settlement with Chipotle could have been free Chipotle for life. Now, guys, remember, on this channel, we don't buy based on price. We need to be able to understand where price is relative to value. If price is below value, we're excited. If it's above value, we're not as excited. Now, how do we determine value? That's what we're going to talk about and break down. So Chipotle here is a $52 billion company. All-time high, $69 about a little over a year ago. And now 52-week low, just today, $38.32. Our community members, 45 community members have this listed as a hold. Nobody has it as a strong buy. Now, guys, 35 times free cash flow, 33 times earnings. That's a high number, but you got to remember that number in and of itself tells us nothing about if it's a good deal or not. And here's why. Let's say you had 2 companies. Both were selling for 35 times their earnings or free cash flow. One was going to grow its profit 100% a year for the next 10 years, and one was going to stay flat. Are they both valued the same? Of course not. The one that's going to grow 100% a year in its profit, you should be selling your soul and your family's soul. You should be selling everything you know to buy that company. These are all metrics we look at all along the way to sit there and give us a story and idea, okay? Now, no dividend, which I love because this is a growing company. And I just saw that they're opening some stores in East Asia, which is a new thing for them. Very little acquisitions, obviously, because Chipotle is its own brand. And look at this revenue growth. 10% a year for the last 10 years, 15.5% a year for the last 5 years, 12.5% for the last 3 years. And 5-year profit margin of 11.6%. Last year, 13.5%. So significantly higher, 20% higher almost than the 5-year average. That's pretty significant. What's cool is literally their 5-year average free cash flow and 5-year net income are exactly the same. So there's a lot of positives here. And another cool thing, market cap is $52 billion. Look at their enterprise value. This difference of about $4 billion is essentially their debt. And this place has leases, lots and lots of leases. So this company has a great balance sheet and they can pay off all that debt with like 3 years of cash flow. Guys, if this is your first time hearing it, we have a great free PDF that'll explain all of these metrics to you, give you the ideas behind them, why we look at them. Click the link below. Within a minute, you'll have that PDF absolutely free in your inbox. So if you want to learn these things and watch more videos of ours, these are some important metrics to understand. And obviously I went through it quick because we have limited time in a video. So please go check that out, absolutely free. Now, the 8 pillars here. Guys, look at this. Everything's a check except for these valuation metrics. Now, I will say one thing. They've bought back shares when this company's been selling for high valuations. Okay, not terrible, not great, but it's basically a valuation metric here. And guys, look at this. Their 5-year return on capital is 13.5%. Their 1 year is 20%. The reason that's important for Chipotle is they still have a lot of room to grow and to reinvest. These 2 numbers here tell us that they get a high return on the money they invest in their business. So when they open a new location, it's very profitable, adds a lot of profit to their bottom line. So as long as this continues to go up and get better, it's going to show us what a great company Chipotle is. Now, what are analysts saying about this company? Well, guys, they seem to be pretty optimistic. They have $1.23 in profit for this year, growing to $2.39 in the next 4 years. That is what? About 2 times the profit in 4 years. That's pretty solid, guys. And for revenue, double digits basically every year but this year, according to analysts. Huge growth here. Huge growth. Do not sleep on that. And remember, guys, this can feel overwhelming. Feel free to rewind. Make sure you download that PDF for free because I want to make sure that you get the most out of these videos. And having a foundational way of which we watch videos, even if you're an advanced investor, I want you to know in which the way I look at them so when I say things, you understand it. Again, doesn't mean you're going to agree with me on everything. That's not the goal here. The goal here is I have tons of value investor friends that we disagree on pretty much every company we look at, but our fundamental beliefs are still the same. And that is exactly why I'm teaching on YouTube. I always saw that people wanted to mimic Warren Buffett, all this stuff. I said, no, you can't mimic because if you just copy what they buy, if the stock falls, you're not going to be able to know why it's falling and what you should do. You've got to be able to have your own process of thinking. Whether you agree with my views on Chipotle or the next 2 companies doesn't matter. What matters to me is that we agree on the foundations and the fundamentals, and that's why I do it. And in just a minute, I'm going to go through our stock analyzer to say what's the price we want to have here. But remember, we buy a stock, we're buying a piece of a business. That's what's key here. You're not buying some ticker that goes up and down. You're buying a piece of a business. So our stock analyzer tool is going to help us put the numbers and the story together. Chipotle is still opening more stores, still has a lot of potential. It's really important that you're able to sit here and understand what the right price for you is. Here is a 10-year analysis I did a while back. I did 5, 9, and 13% revenue growth. Guys, one thing I want to show you is increasing returns on capital. That's great. This is a premium business. They deserve a premium. Profit margin. I did 10, 11.5, and 13. Guys, I think I'm going to adjust this. I think I'm going to go a little bit higher here. I'm going to go 10.5, 12, and 13.5 because it seems like they're doing better about generating profit on the bottom line. So I think justifying a higher profit number makes sense. In fact, if somebody sat here and went higher than this by 0.5% or 1%, I would understand that. PE. Guys, what's the PE you'd assign to this company in 10 years? Guys, all of these assumptions we don't know. That's why we make low, middle, and high versions of them. But I put 18, 22, and 26 because I think this is a company that's going to be around for a long time. I see these increasing returns on capital, and I think this company is going to be a premium company for a long time. And guys, if you're part of our community and you want to learn how to make great stock analyzer choices, make sure you watch this video. It's there to help you make good assumptions and good inputs into this. Now, finally, our desired return. Guys, I put in 9%. That is not the kind of return I want for Chipotle, but I want to find the intrinsic value. What's the value of the business right now? So I put 9 or 10% in here to match the market. But remember, when you buy this company, you need to have a margin of safety. How do you get that with a stock analyzer tool? You put in a higher number than 9%. What's that number? Depends on your situation. It could be 10%, it could be 15%, it could be 12%. It all depends on you. But the bottom line is I hit the analyze button. The stock's currently at 38. I have a low price of 18, a high price of 55, a middle price of 32. Now, it's on my watch list at 30 because I want to take a look at it at that point. But right now, I'm just going to be a little patient. I'm not in a rush to buy Chipotle for myself. And guess what, guys? For those of you who think that that wouldn't happen very quickly, just remember how much the stock has fallen in the last 1 year. Things change very quickly in the markets. Stock number 2, Lululemon. Guys, we have looked at Lululemon a lot lately, and the reason being is, 1, people in our community are absolutely obsessed with looking at this. Why? You'll see in 2 seconds, and I'll show you why. But 2, it's very active out there in the world. We pay attention to what people are looking at. Now, it's retail. It's not like Nike. It's a newer brand, but it's a higher end brand, and it's considered a luxury. So they've been hitting a little bit of the skids lately, as we've seen in the economy. But here's why you need to take a look at it. All-time high is $516, less than 2 years ago. It is currently trading at $166. Again, This does not make it a buy today. What makes it a buy is when we compare price to value, but it's very interesting for this exact reason. And guys, we have 94 community members who voted on this company, and they have it as an average of a buy. And I'm pretty interested in it. I will say there are issues with it. What are the issues? Well, it's a newer brand. But what's some great stuff? $20 billion market cap versus $22 billion enterprise value. Very little debt, $2 billion in debt versus $1 billion a year in free cash flow. That's pretty significant. Guys, 5-year profit margin, 15%. Last year, 16.5%. But even more so, this gross margin. Every unit they sell, their gross margin is 60%. That means if they sell a $100 item, $60 of that goes to the bottom line before taxes and before overhead. That's huge. This is almost software type numbers. That's what I want you to remember. Growth in revenue. 19% a year for the last 10 years, 23% a year for the last 5 years, 15.5% a year for the last 3 years. People are saying it's a dying brand. I think it's a luxury brand that now that consumers are being a little bit more cautious, it's gonna be hit. Now, I have 33 stocks I want to own forever. Lulu's not in there, but it's not because I don't think it's gonna last forever. And as time goes on, I will know whether Lulu's gonna be in there or not. Will they stand the test of time? Will it become like another Nike? Will they get acquired by somebody? These are all the questions to think about. The biggest issue I have with Lulu is exactly that. Like, okay, they're a great brand and people love them, but are people going to sit there and say, you know, I don't want to pay $150 for yoga pants? Guess what? Somebody's going to want to pay a premium. Nike sells shoes for $200, $300 a pop, and aftermarket they sell for thousands. People like luxury. Maybe right now, because the economy seems to be slowing and inflation's kind of taking a hit on things, it might be hurting Lulu more than they want. So for me, when we do our stock analyzer tool, which we'll get to in a second, for me, my desired return is going to be much higher than everything else. Why? Because I'm not dying to have Lulu. But if it gets ridiculous enough, I absolutely will buy it as a short-term value play. But it's not a company right now that I think I want to own for the next 30 or 40 years. I would not be shocked if Lulu was not around in 20 years. Nike, I'd be absolutely floored. That's the way in which I think about my investing. So let's get to that 8 pillars here real quick. Guys, it's an 8-pillar thriller. Everything is a check. Everything here is a check. Incredible. Low debt, buying back shares, high returns on capital, over 24%, great growth in revenue, profit, free cash flow, and selling for reasonable multiples. Okay, let's go look at analysts. What are they saying? Analysts have the company making $15 a share, growing to $24 per share in the next 5 or 6 years. That's big growth, guys. That's 70% growth in the next 5 or 6 years. And revenue growing, not sexy. 6%, 7%, 5.5%, 10.5%, 7%. But when you have that 60% gross margin, it can really shove a lot of profit to that bottom line, which is very, very key. Now, let's go to our stock analyzer to put this all together. Guys, another 10-year assumption. Now, guys, I'm going super conservative. I'm going to say their sales are going to be hit hard. I did 2%, 4%, and 6% revenue growth. Guys, that's absurd. I'm changing this. I'm going 4%, 7%, and 10% revenue growth. Profit margin. I did 14, 15, and 16, but look at this. 10-year average is 14.5, 5-year average is 15, 1 year is 16.5. I think they're on the upward trend of profit. Their free cash flow is lower than normal, lower than their profit margin, so I went 13, 14, 15. Now for the price, the PE ratio, guys, they're currently selling at 11. It is retail. Now, I think that what I'm going to do is, instead of putting a low PE here, I do think it justifies a higher PE. But what I'm going to do is I'm going to increase my desired return for my margin of safety. If I put margin of safety in everything here and then another margin of safety in here, I'm just butchering the company. What I want to do is put in what I think is reasonable up here and then put in my higher margin of safety down below. Now, guys, back in the day when I first started investing, I would have probably bought Lulu without doing any analysis. Why? Because I would have thought, oh, it's a cool story. In fact, now that I think about it, I might not have bought Lulu because it's down so much. I would have said, oh, that stock is a loser. I was chasing hot stocks. I was following tips from my sister's boyfriend's father. I was getting caught up in the hype, hoping that something would stick. But guys, that's not investing. There's no process there. That's purely speculation and gambling. That's exactly why we created Everything Money, because over time, I was able to change the way in which I think. And I wish I'd had these tools in this community and YouTube back then to learn, because I guarantee you I would have shifted my mindset a lot faster. So when you join Everything Money, you're not just getting these software tools, the stock analyzer tool, which is incredible, that's used over 1 million times per year. You're getting a strong foundation. You are upping your investing game. We integrate you into the community by letting you watch courses that are absolutely free, so we all have the same foundation. And if you get engaged in our community with people who are leveling up their investing just like you have nowhere to go but up in terms of your quality of investing decisions. And alongside that will be what? Probably better returns. And guys, even more exciting, we're adding a broker platform to this. Now, it's not gonna be our brokerage. We're letting you integrate your brokerages. Things like Robinhood, Fidelity, Schwab, all these major brokerages that you can sit there and join in, attach it to the account. We never hold the money. It still stays in those brokers, but allows you to make those decisions and buy without having to flip screens all the time. This is going to make it so much easier than ever for you to up your investing game in one place. And this is the next chapter of many chapters for Everything Money. But let me be very clear. If you're trying to chase the next shiny object, if you're trying to chase the next hype, we're not the place for you. In fact, I don't even know why you made it this far in the video. If you've made it this far, it's probably because you're either a legitimate investor right now, or you want to be one. So if you're not ready to follow a process and stick with it, don't sign up, don't watch our videos. But if you're committed to investing the right way, start your 7-day trial right now. Click the link below. We have limited spots every day, but if you're serious, I'm sure you're gonna do very well, and I'll see you inside the community. So guys, these are all my assumptions. I hit the analyze button. The stock's currently at 166. Look at all this green. A low price of 190 to 200, a high price of 430 to 450, middle price of 280 to 300. Guys, this means based on today's price, you're looking at a 16% return. Now you might sit there and say, Paul, is this not good enough for you? I don't know. I always just sit there and say, what's the upside worth to me? Is it worth 16%? Probably. Maybe a little bit higher. I've said to people, our analysts in-house, like, hey, maybe I want 18, 19% return on Lulu. And if I miss it, I'm fine with that, because I like to invest the way I like to invest. So let's say I wanted an 18% return. I would type in 18 across the board. And on my middle assumptions, it means I need a price of 155. Guys, that's not far from 166. So guess what I can do? I can sell puts. Now, if you're new to investing, you've probably never heard of puts. What puts are is it's a contract that allows me to get paid to buy a company at a future lower price. That was not a typo. You did not hear that wrong. It literally means that somebody's gonna pay me to buy Lulu at the price I want it for. So let's say I want it for 150. Let's go a little bit less than 155. I go to October 3rd. No, let's go to October 10th. That's a month from now. I go to my puts, and by the way, guys, this is gonna be on our site. This is in dev mode right now for us to test out, but it's gonna be all here for you. Puts for 150. So I go to 150, it pays $1.54. And on our site, I don't see it anywhere else in the world, that's a 13% return. That means if I do this over and over and over again, I will either make a 13% return on my cash, or I'll get the stock at the price I want. That allows me to make money waiting for the company. Now I just went up to 13.1% because the price went up. Guys, this is one of my favorite things to teach. It absolutely changed the way in which I invested. And it's the one thing if you said to me, Paul, if you could go back in time and teach yourself something, that would be it. And this fall, we're gonna be doing class on it. We already did one. It was a phenomenal success. So make sure you watch out for that, because it'll change the way in which you invest, and it'll increase the income on the cash in your account. It's absolutely incredible. Let's go to stock number 3, which is UPS, United Parcel Service, $84 per share. Remember, we don't care about the share price quite yet. It's a $71 billion company with kind of a $120 billion market cap. That's kind of a lot right there. That's $49 billion in debt. And their free cash flow, look at this, a little concerning. $6.65 billion a year for the last 5 years, $3.5 billion last year. So maybe this is why the stock is down so much. So the first thing I'm gonna say is, gotta understand why it's down so much. But it's only selling for 20 times free cash flow last year, 10 times its 5-year free cash flow. And look at this, guys. 7.6% dividend yield. But I want you to see something. That means they paid $5.4 billion in dividends last year. Guys, they only generated $3.5 billion. So they had to dig into their pocket to pay that dividend. So unless this is a short-term drop that's going to go right back up, that dividend's probably not going to be safe. So it's something to consider about UPS. I'm not saying for sure that it's not safe, but it's something to actually consider here. Now, all-time high was 233, and it's at 84 now. And that all-time high was in February of 22. Guys, if I told you in February of 22 the company would be down to 83 bucks with a booming stock market, you'd be like, you're crazy, Paul. Well, things happen. It just goes to show that anything can happen in the markets. Let's go check out our 8 pillars here. All right, so we saw a lot of debt there. That $40 billion in debt has a higher debt. Am I as worried about that with UPS? It's an established company, probably not. But their cash flow is down significantly like we saw over the last 5 years. That's a big drop. Big drop. Their 5-year price of free cash flow is 11. Their 5-year PE is 9. Is this a short-term thing? And guys, look, 5-year return on capital, 17%. This one's a doozy. Let's see what analysts think about this company. They have this company growing from $6.60 a share in profit this year to $10.80. 11%, 11%, 25, and 6. And that's after a 13% drop this year. What about revenue? Well, 4% drop this year and not much growth. Yeah, 3 to 5, 6%. And I would have guessed that for a company like UPS. They're going to grow along with the economy. As the economy grows, their revenue is going to grow along with it. Now, what do I think of UPS? Guys, I think UPS is going to be around for a very, very long time. But remember, the goal should be, as Warren Buffett says, to buy a business, to buy stock in a business at a rational price where it's almost guaranteed that 5, 10, 20 years down the road, they're making substantially more profit. Is that the case here? Guys, if I were to ask you randomly, do you think UPS will have more profit 20 years from now than today? Probably say, yeah, it's going to have more profit. So the question becomes, what's the right price to pay? And you know what we do to find that out? We go to our stock analyzer tool. Now, before I get to that, guys, there's something I want you to do. I want you to pay attention after our UPS stock analyzer tool, because there's a video I'm going to tell you about that you need to watch where I applied all of these into my own process to go against this incredible Magnificent Seven. But let's go to UPS stock analyzer tool here. Okay. 10-year analysis, I did 2, 4, and 6%. Profit margin, I did 7.5%, 8.5%, 9.5%. For free cash flow, I went 1% lower, 6.5%, 7.5%, 8.5%. For PE, guys, look at the 5 and 10-year return on capital, 17% and 20%. So it's a premium company. I did 15, 18, and 21. So I started at the market average of 15 and went a little bit higher. And of course, my 9% desired return. The stock's at 84. I hit the analyze button. Low price of 100 to 115, high price of 215 to 240, middle price of 150 to 170. And guys, keep in mind, these returns include the dividend. So don't add that 7.5% dividend to this. It includes the dividend. If they took the dividend away, these would not change. That's the big key there. So this is something to look at. And guys, I'm going to add it to my watch. I might actually even like sell some put. Actually, let's go look at the puts on this one. Let's see. Stock's currently 84. Let's go back to October 10th. Let's do 5 strikes on the puts. $80. Look at this. The $80 strike price for October 10th. 17.1% return annualized. 1.4% monthly. This allows me to buy the stock at 80 and be paid $1.09 for that to happen. So if I get it, I still keep the $1.09 and I get it for 80 bucks. I will explain more there. It's not a free lunch. But like I said before, guys, earlier this year, I did pick 7 stocks at the start to go head to head with the Magnificent Seven. And guess what? The results are incredible. They're actually winning. And I'm not just talking about theory. I put these stocks that I own, to the test, and they're outperforming the market's biggest names. So click the video on your screen to see which 7 stocks that I picked are beating the Mag 7 and why I think they will keep winning for years to come. Thank you for your time.